Greetings, Ed Yardeni here. It's, what is it? It's November 29th. It's almost the end of the month. Let me straighten out my tie here. I'll tell you about the fish in a minute. Hope you all had a wonderful, great Thanksgiving. We still have cabin fever from the lockdowns last year, so we decided to go to St. Martin, and we were a little concerned there because there's some news about unrest for various reasons, anti-vaxxers and the like. But anyways, we had a great time, and I went deep sea fishing for the first time ever, and this is what I caught. It was actually quite a nice big snapper. Queen snapper apparently is one of the better ones, queen red snapper. And sure enough, we cooked it for Thanksgiving. So our Thanksgiving was good, but we didn't have a turkey down in St. Martin. Instead, we had this fish. But let me avoid distracting you with this background here and go back to my normal background. Give me a second. Okay, good. Okay, I'm back. No more fooling around. We're going to get serious here and address the issues of the day. Clearly, a lot of things to talk about. First and foremost is the new variant of the COVID, Omicron. And I'm, based on everything I've been reading, it's available so far, and it isn't much. I have to go under the assumption that it's very comparable to the Delta variant, in the sense that that we will find that there are ways to deal with this problem, and it'll be vaccines. It's very encouraging that on Friday, just as the market was taking this big sell-off, the companies like Pfizer and let me see something here. Somebody want Pfizer and Moderna came back and said that they think they can tweak their vaccines pretty quickly here. Also, don't forget, we've already got some medications, some pills that can deal with some of the consequences of getting COVID. So I don't want to, dismiss this at all. I mean, the pandemic clearly isn't over. I think we're kind of coming to the conclusion that we're going to have to live with this thing for quite some time. And that being the case, we have to get on with our lives as best we can. Some of us who think that vaccines work can do it that way. Others who want to take their chances and wind up in the hospital can do it that way. But look, the fact of the matter is we've been living with it for quite some time. The big upset was when we had 2 months worth of lockdown. And ever since then, as the lockdowns have been lifted, we've seen a tremendous recovery in the economy, and we're doing rather well. So I view the sell-off on Friday as panic attack number 71. We've been keeping track of all these various panic attacks since the beginning of the bull market. It's not science. We're not calling these things corrections. They don't have to be down 10% or more. They could be down like 2.4%, as was the case on Friday, and just be a one-day phenomenon. But they should be full of anxiety-prone action in the market as investors fear that this will be the event that causes a major recession and a major bear market. I mean, let's face it, we had that last year. That was, technically speaking, a bear market, though Joe and I prefer to view it as a panic attack because it didn't last very long. I think it lasted altogether 33 days and 20 trading days. And of those 20 trading days, only in 7 of those trading days was the market down by more than 20%. So we build that as a panic attack. And in that case, we view the current bull market as ongoing, as the one that really started in 2009. So that's where our thinking is. And we're still looking for 4,800 by the end of the year. Got there pretty close on Thursday at 47, something like we're 4,700. Then next year we're looking at 5,200. And then in 2023, we're looking for 5,500. I mean, they're bullish outlooks, but they're not crazy, insane numbers. They're kind of consistent with what we think is a reasonable trajectory for the growth rate of earnings. What is kind of crazy in our forecast is our expectation that the valuation multiple is going to remain high, around 20 to 22. And that's even with the Fed starting to taper already its purchases and may very well accelerate tapering its purchases. We'll see how they may not because of the new variant of the virus, but they will continue to taper. The only question is whether they're going to do it at a faster pace. But I think it's widely expected now that there will be 2 rate increases in the Fed funds rate next year. There's actually quite more people thinking about 3 rate increases, though. After Friday's action, some people had second thoughts in the markets. The 2-year Treasury note came back to around 50 basis points above zero. So that implies 2 rate hikes in the federal funds rate sometime next year. And that's where we're at, 2 rate hikes next year, with the possibility that the Fed will respond to higher than expected inflation by raising the inflation target from 2% to 3%. Still looking for inflation to be in the 4 to 5% range over the rest of this year, going into mid next year. We got to 5%, actually the top of our range in October on a year-over-year basis in the PCED deflator. And then by the second half of next year, we're looking for inflation to calm down some to 3 to 4%. Let's look at some of the charts here that we are covering in the covered in the morning briefing today. So once again, we're going to the website, and once again, I'm giving you an opportunity to see the website and how we navigate it. So here we're going to the morning briefing. We'd like to pick up the charts over here. So let's see what we got first of all, we clearly have to address the pandemic. Austria is back in lockdowns. Germany is seeing its COVID cases absolutely soar. The stock market, meanwhile, remains on a strong upward trend, though. On Friday, we had a reaction to, I think the market was already a little nervous about a week or so ago when Austria announced lockdowns and when the German infections really took off. So there was also quite a bit of nervousness in the market, but it really came to a head on Friday with the announcement that there was a new variant and nobody knew very much about it. And we still don't know very much about it. But again, I'm working under the assumption that it's a variant like the Delta variant and will be dealt with, and that life will go on. You can see here in the US, the COVID positive results have come down rather sharply, though maybe we're starting to bottom out here. A lot of people are still getting sick, especially those who haven't been vaccinated. But again, the economy's continuing to perform despite this ongoing health situation. And that's clearly visible in figure 4. Let me wet my whistle here. In figure 4, you can see that initial unemployment claims last week, November 20th week, dropped to 199,000, which I think was the lowest since 1969. It may be some seasonal technical aberrations in it, but it's clearly dropped below 300,000, and below 300,000 is where we were during normal times when the economy was performing just fine. And so this certainly suggests that we could have a very strong November employment number on December 3rd, about a week or two before the FOMC meets. And so that's what might get them to conclude that they should be tapering at a faster pace, especially with some of the recent inflation news. But let's see how they balance that off with this latest pandemic news. So meanwhile, by the way, in this chart going back here, you can see that there is a line here for federal jobless benefits were terminated back on, ironically, on Labor Day, September. And this was sort of a point of controversy between the left and the right, where some conservatives were saying it's these benefits that were keeping people from looking for jobs, Well, this chart kind of confirms that once these benefits were terminated, it looks as though people came back into the labor market, and it's certainly easy enough to get a job when you got job openings at 10.4 million, and you got the unemployed workers at 7.4, and people are quitting. So the labor market's looking very, very good. It's hard I can't imagine that the Fed is going to continue to say that they want to make more progress. Maybe they'll say they want to make more progress, but they'll have to say that as far as they're concerned, they have finally met the test of substantial further progress in the labor market. And of course, they've made more than enough progress in getting inflation above 2%, as you can see here. Again, this is our chart just to keep us honest on this matter, though we can always raise it or lower it, but we'll do that forthrightly if necessary. But for now, we are thinking that the 5% increase in the deflator might have been the top for a while, and that we should kind of mosey along here in the 4 to 5% range and then come down over here. Part of it is we do buy the supply disruption story. And by the way, we're already working on the morning briefing for Tuesday. Today's Monday, so we're doing it for Tuesday. And doing some work on durable goods orders and comparing them to shipments. And durable goods orders have been remarkably strong, all-time record highs. Capital spending is on an absolute tear. And you look at shipments and you don't see them lagging far behind the orders, which kind of raises the question, are we just getting overly hysterical about these supply disruptions? Maybe they're not quite as severe as they may not to be. I think the real problem has been just a demand boom on the consumer side, buying lots of goods. And I think on the business side, we have a demand boom for capital goods because of the panic over a shortage of labor, which I think businesses are come to realize is a chronic problem. So again, the Fed is anticipated, is widely expected to be tapering maybe at a faster pace. But in any event, the markets, if you look here very closely, we're starting to discount maybe 3 rate increases. And after Friday's action, we were back to the 2-year being at 0.50, which basically implied 2 rate hikes of 25 basis points next year. Meanwhile, the reason I think that the market is going to make a comeback, as it seems to have done so far this morning on Monday, is there's a tremendous amount of liquidity in the system. Not all of the liquidity that was provided since the beginning of the pandemic has been spent. There's still a tremendous amount of it that's sitting, for example, in just the total deposits at the commercial banks, and you can see that those continue to increase. You can look at personal savings, and you can see that if you take the 12-month sum of personal saving, it's quite high at $2.4 trillion. So there's been a lot of personal saving going on. You look at the M2 monetary aggregate, which obviously includes the deposit. That's at an all-time record high. And if you just do an eyeball extrapolation here, look at where M2 was trending, you conclude that relative to where it was trending, we're about $2.5 trillion higher than that. So you can call that excess M2. All that M2, if you take the velocity of M2 nominal GDP divided by M2, you can see that it's at an all-time record high. I prefer to flip it around, and when you flip it around, you see that the M2 divided by nominal GDP, all-time record high. And the reason I like to look at it is it just shows that we basically have a year's worth of M2 just sitting there relative to the amount of GDP. So there's a tremendous amount of liquidity available to fund an increase, ongoing increases in nominal GDP. Here's a fun chart that I just kind of concocted. I don't know that I've seen anybody else do it, but maybe it's out there somewhere. S&P 500 market capitalization divided by M2. I was just thinking, everybody looks at M2 velocity, nominal GDP divided by M2. Let's look at S&P 500 market capitalization divided by M2, where M2 is not really a proxy. It's actually liquidity that's certainly available for all sorts of things, including buying stocks. Well, where are we on that? it kind of looks a little bit like the Buffett ratio, but it's no, Buffett ratio is way off the charts here. This one is kind of where it was before the previous bear market. So maybe that's a little bit unnerving. But again, there seems to be a lot of excess M2 that could easily go into the stock market. And we're still well below where we were prior to this bubble situation here. So I'm not telling you the stocks are cheap. They're not. But on the other hand, the liquidity is still formidable. And I think it's going to continue to drive this market higher. So having said all that, let's do a little Q&A here. And I see that there's already one. Let's see. Go ahead and type in some of your questions and I'll respond to them. That's a good one. I like that one. For those of you who came in late, I had in the background a picture of a fish I caught in St. Martin. And the first question is it a sign of decadence or dominance that we can substitute fish for turkey on Thanksgiving, or is it a return to our roots? I don't know. I don't know what it is. All I can tell you is the fish was delicious, and I hope your turkeys were delicious. Seriously, okay, what are the odds that the Fed will panic, raise rates by 75 basis points at their second raising, leading to a policy error, economic downturn, and bear market? That's a good question. I mean, typically recessions tend to be caused by, kind of in my mind, the following scenario. You start with a recession, you come out of it, everybody's being cautious. Then after a few years, you start to forget about all the pain and everything starts to look like a boom. And then you kind of lose your mind and think that the boom's here to stay. You see speculation. The Fed tends to be behind the curve. It doesn't respond as quickly as it should to the speculative excesses, either in asset prices or consumer prices. And then it starts to realize that they're behind, that the Fed officials realize they're behind the curve and start to move more aggressively. And the yield curve starts to go from steepening to descending, heading towards a negative relationship where the short-term rate falls below the bond yield. And I think that all happens because the market anticipates a credit crunch. And the credit crunch occurs, and then we get a recession. So the Fed is a player in all this in terms of possibly causing a problem with a policy mistake. But this Fed is so woke, so liberal, so much focused on employment rather than inflation that I don't think that's going to be a problem. I think the problem will be that they will tolerate more inflation than some of us would like. But I don't think they're going to go for. And look, neither I nor the questioner knows for sure what kind of rate increases it would take to really cause a problem. Okay, I don't know why I've been getting this question in a couple of places by email. It's like, what airlines am I still bullish? I don't believe I've ever expressed an opinion on airlines, but I do think that the sell-off we saw in some of the opening trades over the past year, and as they got whacked on Friday, I think they'll make a comeback as the economy continues to make a comeback. And all I can tell you is the flights down to St. Martin were packed, and coming back to St. Martin were packed, and the airports were packed. So I think the airlines are going to get through this latest version of the virus. Could you expand on your? Oh yeah, could you expand on your point about the market maintaining its valuation levels despite rising rates? I see that as one of the basic underlying risks to the market. Yeah, it's a good point, and I said up front that I've got a fairly reasonable outlook for earnings, and that's what I think the market will increase at. But the market won't increase even if earnings go up. If the valuation multiple gets whacked, obviously it would be a different scenario. it would be more sideways market or even a down market. I think valuation multiples do obviously tend to get stretched near the end of bull markets. But what brings them down is something causes a bear market. I mean, you could have a correction that could bring it down temporarily, but what really brings them down hard is a bear market by definition. And what causes bear markets is a recession. I don't see a recession over the next 12 months, 24 months. So I think we're going to continue to see valuation multiples stay surprisingly high, especially in the context of all the liquidity that we just looked at that's out there that's isn't going to go away overnight. As a matter of fact, the Fed, by tapering at a slower pace, will still be filling the punch bowl. Do you think rising interest rates will in reality be negative for large cap tech in 2022? You know, we've been following the Magnificent Eight now. It used to be just the Magnificent Five, but it's the large cap stocks. They're not all tech. Some are kind of quasi tech, but they're Amazon and Google is communication services and the like. The Magnificent Eight are trading around 40 times forward PE. I think they sort of deserve that simply because they're big and keep surprising us with remarkable earnings growth. So that's so I think that's why they're so highly prized. I guess we have to watch out for regulatory issues. There's obviously progressives who like to break some of them up, so we'll see how that plays along. When you take out the Magnificent Eight, you find that the forward PE is, for the S&P 500 instead of 2021 is more like 18. So it's the rest of the market isn't as crazy crazy valued as the Magnificent Eight. But we've seen a few times now when the bond yield's gone up, the knee-jerk reaction was to get out of growth and get into value, particularly into financials. And, you know, it seems like these are kind of knee-jerk reactions. And the reality is the fundamentals of these stocks are still quite good, even if the bond yield goes to 2%. How's that really going to radically change the prospects for some of these big cap growth names? So I would say that, you know, if you're into growth and you get these opportunities where they sell them off and you have some cash, then it's a good they're buying opportunities is the way I look at it. What sectors can we expect to do well? Tech, because we worry about the pandemic again. Okay, I've previously discussed with you my crazy idea that you should look at your portfolio and ask yourself if everything is a tech stock. And again, that sounds crazy. It sounds like I'm telling you to put 100% of the portfolio in technology. That's not what I mean by that. What I mean is that all companies are technology companies now. They either make technology or they use technology. And if they don't use technology to increase the efficiency and productivity of their operations to boost their profit margins, then they're going to go out of business because their competitors will do that. There's a very interesting recent article in the Wall Street Journal that said we should all shut down our IT departments because we shouldn't really view IT as a department. It's not something separate and different. If you think of most manufacturing companies are technology companies. They don't view technology as sort of a department that every now and then comes in and you know, spritzes some WD-40 on the equipment. The technology people are fully integrated into the operation of the company. I mean, you know, Tesla is a technology company, and GM and Ford, they've become technology companies. And so the technology people really are part and parcel. They're integrated into the whole operation. Look at Amazon. You know, Jeff Bezos stepped down and put in the fellow who basically recreated Amazon to a large extent as a cloud company. So that's what I really mean by technology being sort of a key factor in looking at your portfolio. So I'm not telling you technology is cheap, but on the other hand, the prospects for demand for things like semiconductors, artificial intelligence, robotics, automation. Those are all just phenomenal. And they're real. They're not like .coms. They're real businesses and real demand for goods and services. So that's kind of the way I'm looking at things. And by the way, you'll notice that a lot of the other sectors are now have some nicknames in their technology area. So you got fintech, you've got medtech, and so on. And that's what that's the way we're thinking. By the way, just to give you a little heads up, Jackie and I are going to be doing even more work on disruptive technologies. I kind of, I know Kathy Woods very well, and she's done an outstanding job in creating this ARC funds. And now she's talking about shorting the companies that might suffer from disruptive technologies. So I think that does make sense. But Jackie and I are going to start to look more into nuclear energy. And we're not talking about fission, we're talking about fusion. It's been brought to our attention by a couple of accounts that there's some really interesting progress being made in the ability to maybe finally get nuclear fusion to work, which would be a total and complete game changer. So it could very well be the roaring 2020s leading to the, I don't know, the sun will come out tomorrow, decades ahead, or the perpetually sunny outlook. So look for more work on fusion energy on our part, which is getting us pretty excited about the future. I got a few more minutes. I'll take a couple more questions here. Thoughts on rates by the end of the year and end of first quarter 2022. Your thoughts on where we should be and on real rates. Well, I've been thinking for a while we should be at 2% based on a lot of factors like the economy doing awfully well, but that hasn't happened. It certainly was not the case. I guess we got to 1.7% there for a while in March, so we came back down in the summer to about 1.1%. And I think that had something to do with the Delta concerns about the Delta variant. And now here we are back at 1.5. We'd been at 1.6, almost 1.7 a few days ago prior to Friday's scare. I still think we should be at 2% on the 10-year. I think what's been keeping it down is, well, the pandemic, as we saw on Friday. All it took was fears of another variant, and we saw the bond yield coming back down. But in addition to that, you've still got negative bond yields or zero bond yields in Japan and in Germany, and I think that's been a factor. There's a lot of people out there that don't necessarily want to be in the stock market with these kind of valuation multiples that do actually view bonds as an alternative to stocks, believe it or not. And as a matter of fact, we've been monitoring the inflows into bond equity, bond mutual funds, and bond ETFs. And the inflows have been very strong all year. So they're clearly, the whole TINA ID hasn't really been very accurate. There has been an alternative to stocks, and that's bonds, even though for some of us, those yields don't look particularly attractive. Let's see what I got here. Oh, we still don't know what the final BBB details will be, but I am surprised there hasn't been more positive commentary on no increase to the corporate tax rate. Well, first let's talk about that infrastructure spending bill of $1 trillion, which is really $550 billion on top of what had already been authorized. So that's the $1 trillion. And we're doing some work on that for tomorrow, and have come to the conclusion that we may not be shovel ready for this kind of inflow into our, for the kind of business it implies for the construction industry. We're pretty much at full employment in the construction industry, and I'm not quite sure where they're going to find people to build all these infrastructure projects. But they are saying this is not meant as a stimulus program. It's meant as an infrastructure, a long-term program for improving our infrastructure, and it is I mean, it's doable over the long term, but in the short run, it's going to be a real challenge finding workers to do all this. Now, with regards to the Build Back Better program, which is basically social infrastructure, I guess, and I guess the last number is something under $2 trillion there. It's the reason nobody's talking about it is it's hard to say where it's going to go. So it's still up in the air, and nobody's quite sure how it'll all play out. I will probably reassess my relatively optimistic outlook on inflation in the event that this thing is passed, because I think it could only worsen the inflation picture. So we'll see. We'll see how that plays out. But look, I want to thank you all for tuning into the webinar. I always enjoy it. I hope you did as well. And I'll see you next week. Goodbye.